The Fed's cutting interest rates. So, will home prices jump? Let me break the chain reaction in plain English. Rate cut to price tag, so you can see what's likely next. First link, borrowing costs. When the Fed lowers rates, it pushes down many borrowing costs across the economy. Your 30-year mortgage isn't set by the Fed directly, but mortgage rates usually follow the trend. Even a drop of 0.5% can save hundreds a month on a typical loan. Lower payment, same house. Second link, buyers wake up. With cheaper monthly payments, more first-time buyers qualify. People who were waiting on the sidelines run the numbers again, and some jump in. Investors do too, especially if rents look solid. That adds demand. Third link, demand meets thin supply. Here's the problem. Inventory is still tight in many markets. Owners who locked 3% mortgages aren't eager to trade up to higher rates, even after cuts. Rate cuts help, but they don't erase the lock-in overnight. So if demand rises faster than new listings, prices get pushed up. But not everywhere. Real estate is hyperlocal. If your city has strong job growth, limited building, and lots of millennial buyers, cuts can fuel bidding wars. If you're in a market with new construction, looser zoning, or slower population growth, prices may move less, or just stabilize. Let's talk inventory dynamics. Do cuts bring more homes to market? Some, yes. Move-up sellers finally see a payment they can stomach, so they list, freeing starter homes. Builders also get better financing, so they're more willing to start projects. But construction lags take months to years, not weeks. So in the short run, demand usually moves first, inventory second. Mortgage demand reacts fast. You'll see spikes in pre-approvals, refis, and rate lock activity. That rush can compress days on market and pull prices up in hot neighborhoods. Sellers notice and price a little higher. Affordability sits in the middle of this chain. Lower rates improve monthly affordability, but higher prices can cancel part of that benefit. If cuts continue or job growth strengthens, buyers can absorb some price gains. If incomes lag, the market hits an affordability ceiling and cools. What should I watch? Mortgage rate trend versus last year's payments. New listings and months of supply in your zip code. Builder permits and price cuts on new homes. Bidding activity. Contingencies waived, multiple offers, and days on market. So, will the Fed's cuts boost home prices? Likely yes, especially in the near term and in tight, high-demand markets. The magnitude depends on how quickly inventory loosens and how far rates actually fall. Short term, demand pops, prices firm, or rise. Medium term, if listings and new builds pick up, price growth can cool. If I'm buying, I get pre-approved, track rates weekly, and target homes with longer days on market for negotiation. If I'm selling, I list into the demand bump. But price with comps, not hype. Rate cut to price chain. Cheaper money, more demand, inventory catches up later. That's the playbook. Now check your local data and make the market work for you.